Okay, welcome everyone to today's lecture. Last time we stopped with the valuation of linear assets and a simple introduction to the different types of financial derivatives, especially options we can see on the markets. And now we want to continue this with the discussion of forwards and futures as very basic examples of unconditional financial derivatives. And you will see that these are just very simple forward contracts in which you buy something before delivery and before payment. In contrast to a forward, a future is just a version of a forward contract that is traded on an exchange. So we'll talk about this here, and then afterwards, after we have seen what an option is, what a forward is, and what a future is, we will talk about the valuation of these financial contracts. If you want to read a little bit more into this, you can take the Investment Management and Risk Management book by Albrecht and Maurer, but actually you will find the discussion on the slides, especially in this textbook, but you can take any textbook on financial derivatives and they will usually all start with financial forwards and future contracts. Okay, so we'll talk about forwards, futures, and then later on also swap contracts, which, as the name suggests, are contracts in which we swap usually fixed versus floating rate payments. And all these instruments are, of course, used extensively for hedging exposures you might have, for example, from a contract in a foreign currency or from an interest-bearing contract. And we'll see this later on. But all these contracts are really about hedging. Okay. So forwards. Let's start with forwards. We need some notation for this. And in the following, capital T will be the settlement date of a forward contract. KT is the underlying value in T equal to capital T. The K actually is chosen because of the German word Kasse, which is the German equivalent of a spot price. So I have to admit the notation has not yet been adjusted to the English language. Maybe later on we'll see an S, but for this you need to know that this is the spot price. In German it's a Kassakurs. Okay, S, small s, is the contract date at which you've bought the contract. Obviously, S will be smaller than capital T because otherwise you will have no duration left on your contract. KS is the current underlying value at the time you've bought the contract. And FS is the agreed settlement price upon contract fulfillment. So what happens in a forward contract? At time S, you are buying a commodity, an underlying. You are obliging yourself to buy this underlying for a fixed price, FS, that is fixed today at point S, but the underlying has a current spot price of KS, meaning that it might be that KS is equal to FS, but usually we'll expect prices to change, so KS will not be equal to FS. FS is the forward price, KS is the spot price, and you are right now here at small s. Here you have capital T, and you have KS. It might go up and down, and then you have KT, and here you are buying the forward and you are agreeing to pay FS, which is of course in this case FT at the end. Now what does this mean? It means that, for example, you are now buying 1 ton of steel, 1 ton of coal, or maybe 1 ton of pork bellies for delivery in 1 year. And you are agreeing on a price of, say, 100 euros for this ton of steel. Although the current price of steel, the spot price might just be $80 or euros. And the difference between the spot price and the forward price is, of course, essential for hedging purposes. Now, what is a forward? A forward is when you purchase it at time S with settlement date capital T, You agree to settle the agreed number of underlyings at the agreed price Fs, and this is an unconditional financial contract or an unconditional financial derivative, meaning that if you are buying or if you are selling a forward contract, you have to fulfill it. You cannot opt out. It's not an option. You cannot just say, oh, the prices have developed adversely to my interest, and I'm no longer interested in this contract. You have a contractual obligation to fulfill this contract. If you buy it, you are long. If you are selling the forward contract, you are short. And here you can see why selling and why going short is possible even without short sales. Now, usually in a spot market, you can short sell a good, meaning you are lending. You're lending a good from someone, an underlying, and you're selling it even though you don't have it. And then afterwards, you have to settle your position, and you have to get the underlying to settle the score, more or less. Here in this case, you can go short without short selling. Why? Because you only have to fulfill the contract at the end of maturity. I can, for example, stand here and be a partner in a forward contract, say on 5 tons of coal. I don't have 5 tons of coal, but I can still short coal within this forward contract. I only have to make sure that at the end of this year, I am in the possession of 5 tons of coal. Yeah? So going short is quite easy with a forward contract. You don't need short selling for it. In some cases, the buyer must provide a collateral, and this collateral in this case is called a margin payment. What does it mean? I could go short and I could tell you, I am selling you 50 BMWs. I can short sale, I can go short in a forward contract and I can sell you 50 BMWs. Do I own 50 BMWs? No. If the price of BMWs or coal, whatever underlying we are looking at, if this price appreciates, I will lose a lot of money. And at the end of this contract, I could simply say, oh, I'm bankrupt, sorry, bye. Yeah? Oh, and a nice gong as well. And the problem now is that my partner in this contract will be quite dissatisfied with this contract. And to make sure that I cannot opt out and I cannot bail on my contractual obligations, my contract partner might demand a certain payment in case I'm piling up losses from my forward contract. And to cover those losses that are piling up on this contract, you might be forced to pay a margin payment into what we then call a margin account. And later on, at the end of the contract, we'll look at the forward contract, and then the margin payments in the margin account can be used to cover the losses that have been piling up over this year. So this is the purpose of a margin account. Usually, you will have what we call cash settlement. Now, for example, if we two, okay, now your fellow student is not looking. If you are willing to enter a forward contract with me, and we have as an underlying 5 tons of steel. First thing we need to do is to formalize the details of this contract. 5 tons of steel of what quality, where, in what currency, etc. So we would say, for example, as an underlying, we're using 5 tons of this and this steel in the port of Rotterdam, traded in euros. Now, do we want 5 tons of steel in Rotterdam? Usually not. I would say that 95 to maybe even 99% of all these contracts are not settled physically, they are settled by cash. Meaning that at the end of the maturity, we'll just look at those contracts and we'll see that either I have to pay you 1,000 euros or you have to pay me 1,000 euros. We simply look at the price difference between the spot price and the agreed upon forward price, and we'll see that one of us has lost money. And then we'll take this money and one party pays the other party the difference. In physical settlement, it would mean that I will have to put 5 tons of steel in a certain room, or maybe store in Rotterdam, and you would need to pick it up. And this will cost you transportation costs, it will cost you supply chain and logistics costs and other costs, and then we'll probably agree on cash settlement. Most of these contracts are simply done for hedging purposes. So you don't want the steel, you don't want pork bellies, you simply want to hedge against changes in market prices. Okay. So usually we'll have cash settlement, and we'll have to look at the profit loss position of each of these contract partners. But you had a question.
Yeah, could you opt out of a forward when both parties agree?
Probably a forward contract is usually OTC traded, meaning that it's just up to both contract partners. And if they both agree, you probably will. But then again, at any point in time, one of the parties will lose money and the other will gain exactly the same amount of money. So why should you opt out if not for a cash settlement? What you can do, and what is frequently done, you can settle, you can close down the position, you can close the position. And this means that you ask your contract partner, are you willing to end the contract right now? And the other party will simply say, well, yes, of course, for a fee. And the fee will be as high as the current difference between the spot price and the agreed upon forward prices. But then, of course, both parties have to agree on this. Or the contract needs a special clause for this.
Could you commit fraud like that if your trading volume is high enough and you push the forward price upwards? That you can, for example, make commodities more expensive for your competitors, or your stock on a certain good and can sell it for more profit in the future?
I mean, you can try this, but I would guess in most markets you need so much capital that this is not practically feasible. You know? I mean, you can try to bet against the market and you can try to corner the market. But given the fact that these markets have billions and billions in volume, I think this is not possible for even large funds.
And what you mentioned concerning hedging, the one party always hedges to minimize their risk, and the other party that
speculates, usually. It doesn't need to be one is hedging, one is speculating. It will always, in many cases, it will be that both parties are actually hedging. But for example, if it's quite simple, let's assume that, for example, you have an exposure against the dollar and someone in the US has an exposure against the euro, then it makes sense to swap those currencies for a fixed price. And both parties are hedging. It's quite simple. Yeah?
Okay, so for example, with oil, the company that needs oil would hedge.
For example, producers and refineries and other companies, they will just enter those contracts both for hedging. But there are, of course, a lot of market makers and a lot of companies who are just in for speculation, and they are providing the market liquidity everyone needs. And in many cases, the investment banks will go short here if they know how to run their business. Now, at settlement time, the forward buyer receives the underlying at price Fs. Conversely, he can sell the underlying directly on the market at the current price. So the profit or loss on this contract corresponds to the difference between the spot price minus the forward price. Since the current spot price is equal to the forward price, if you have more or less an infinitely small maturity, in case of cash settlement, the buyer receives the difference KT minus FS, or he or she must pay this difference. Therefore, the profit loss position corresponds to that of the physical delivery. There's no difference between physical settlement and cash settlement. Why should there be? Despite maybe transportation costs. You can still take the goods, the underlying, and immediately sell it on the market. For the short position in a forward, with contract agreement in T equal to S, the seller commits to the delivery, or equivalently cash settlement, of a specific amount of the underlying at the due date capital T and the price Fs. So the profit loss position is exactly the opposite of that of the position of the long position. Showing you again one important feature of all, I would say, all derivatives markets, it's always a zero-sum game. Someone loses a euro, then someone else must win a euro. And you're not creating value in the sense that you create stocks that can appreciate simply because the company is now worth more. Those financial securities are always in zero net supply, and these securities, these contracts, these always pose a zero-sum game. Yeah? This is why derivatives are heavily criticized by left-wing politicians all the time. They are not creating value, they are just there for speculation, blah, blah, blah. Obviously, if done properly, all these products and all these financial contracts can be put to good use simply for hedging purposes. Take this simple example. Take a swap contract. You're swapping and you're fixing an exchange rate between the dollar and US. You have a US company, you have a European company. Both have a risk exposure to the to changes in the currency price and the exchange rate, and if they swap their currencies, they can fix the currency rate. And they both can reduce their risk exposure to zero at a minimal cost, might even be at zero cost. So it's not just a zero-sum game, but it reduces volatility at no cost. So how should this be just for speculation? But again, it's a zero-sum game. Here you can see how this works. A forward contract is actually quite simple. With every euro, the spot price increases at maturity. This is important to note. This is all at maturity. Every euro, the spot price increases. At maturity, also the value of the forward contract increases. Why? Because Fs is fixed. So you have 50 here, and if the spot price increases from 100 to 101, the difference will obviously be 1. So spot price goes up 1 euro, the value at maturity of the forward contract increases by 1 as well. And the opposite for the short position. Increases 1 euro, you lose 1 euro. Because this euro here, it goes down here. So again, in sum, you have plus minus 0. This is a forward, a very simple contract. You're simply buying in advance or selling in advance. And you can imagine that this is one of the very first types of financial derivatives mankind has invented. Even centuries ago, someone had the idea. Actually, do you know how this started? Even probably in ancient Egypt and Mesopotamia. First of all, peasants had the idea, I'm harvesting my wheat, I'm harvesting my grain, and I want to sell it, and I want to fix prices before I harvest the grain, I harvest the wheat. Someone else had the idea, I want to buy wheat now in advance, and I want to make sure that I know the price, and I want to fix the price. So someone agreed in a very simple forward contract. The same happened centuries afterwards when mankind had invented ships and larger ships and merchant ships. People just sold goods and sold the profits and the proceeds from long ship journeys. So when the East Indian Company and the Dutch East India Company When they sent ships, and even the German Hanse, when they sent ships around the world, first of all, they sold stocks. They sold interest in their companies, and they also sold the profits and the proceeds of what came back from these ship journeys and these trade routes. And these are the very first examples of financial derivatives. So you had options, you had forward contracts, and usually they started in agriculture. Yeah? And if you have a look at the Chicago Mercantile Exchange, the CME, which is the world's largest commodity exchange, it's all about forwards and future and swap contracts on those mostly agricultural commodities. Pork bellies, pork lard, pork fat, beef, orange juice, wheat. Do you know one very important commodity exchange where you can buy forward future contracts actually, swaps, and also the spot market, of course? Very important example and very new addition to this. Now, pork bellies and orange juice, those were around centuries, but what has only been recently added to the list of commodities that are traded? It's a very bad sign coming from you. Actually, you cannot see it out of this window, but if we had a window here, you would see the European Energy Exchange. And this is what they do all day. They have a spot market and they have a future market for energy. And you can trade electricity for this type of. You can forward buy, of course, electricity, and you can buy futures. And you have spot and future price for electricity and other types of energy. Yeah? What is a future? Yeah?
Are they limited to cash settlement? Because I think it's hard to deliver electricity.
I don't want to go into the electricity market. The details of this market are quite difficult. You're right, you cannot store electricity, or it's very difficult to store electricity. Do you know actually how this is done? You have large lakes that are filled up with water during the night, and then you let the water flow down via large turbines, and then you can re-engineer the electricity. So you can store electricity to a very minimal extent, but usually you cannot store electricity. So it's let into the electricity network at the same time. But this is very difficult because of this. So I don't know how this works exactly, but I think you actually also have physical settlement. Yeah? So it's the energy market. It's quite different. Yeah.
Yes, I think that Germany sells energy even to negative price to intermediaries.
Yes, of course. And actually, you also sometimes observe negative prices. It's, as I said, the energy market is quite difficult, and it's very different from a financial market. Just imagine it like this. If, for example, you have a power plant that is up and running, the cost of shutting it down and then putting it up to work again, this cost might usually is usually much higher than simply paying a negative price to insert the electricity into the grid. If the grid does not need electricity, it would make sense to shut off the plant, the power plant, for example, a large gas plant, because there's not so much electricity needed, but it's much more expensive to keep it up and running, to shut it down, than simply to pay a price to sell off the electricity. And this again shows you that this market is quite different from a financial market. You have peak hours, you have negative prices, you have very high regulation and different sources of energy again. You have volatility during the day because wind energy and some other types of renewable energy only take up and go up during the night, and that is the time when you don't need electricity. Okay. So what is a future? A future is just a forward contract, full stop. The only difference is the future is exchange traded. It's traded on the CME, on Eurex, on the European Energy Exchange, and apart from this, it's a forward contract. So you have a settlement date T, a contract date S, again a spot price, an underlying value at time T, and the agreed value of the futures based on 1 unit of the underlying FT. But as this is exchange traded, you can observe this future price every day. Every day you can see on the exchange there's a future price to buy or sell a future. This makes pricing a little bit easier. So the settlement price, FS, is not negotiated OTC in the forward contract, but it's observable on the futures exchange. And by the way, this is how we call these exchanges, futures exchanges, because on these mercantile commodity, on these commodity exchanges, you will see futures being exchanged and traded. What is the basis? The basis is the difference between FT minus KT. So the difference between the future price and the spot price. This is what we call the basis. Now, the following also applies. The future price of a future that expires in a second obviously should have the price of a spot price. Why? It's quite simple. If you want to buy in advance with a contract maturity of an infinitely small period of time, this is something you buy on the spot. So spot price should be equal to future price. Then, of course, the basis is 0 by definition, and we can see that the futures price should converge with the maturity going down. So as the maturity of the contract reaches 0, the future price should converge to the spot price. Now, a futures contract that is long, concluded at time S, implies the following payment series. You should see this the following way. In the forward contract, we had a spot price KS. We agreed to this forward price, and KS went like this, and the difference, the complete full difference between the spot price and the forward price, this is what one party had to pay to the other party in the contract. Now with the future, it's a little bit different. On every day, because the future here is equal to the spot price at the end, the difference can also be the difference here, then another one, and in the end you see that you just have to look at those differences between the futures prices from today to tomorrow, from tomorrow to the next day, and so on. And this in sum will give you the profit or the loss from your future contract. But this also means that, for example, if you buy a future, you can have a €5 loss today, a €10 loss tomorrow, and so on. And all these losses will pile up. And in the end, the exchange will say, you have to pay 100,050 euros. The exchange at this point might realize that you don't have 100,000 euros. So what will the exchange do? It will require you as a trader to open and keep a margin account with the exchange, and you have to pay 1,000 euros into your margin account. And each and every day, you will see that your margin account will increase or decrease depending on the losses or the profits you are making from your futures contract. And if you run out of money on your margin account, the exchange will do what is called a margin call. it will mean that you have to pay an additional amount of money into your margin account. If you fail to do so, the exchange will close your account and it will close all open positions. So this is what the exchange at this point can do. It will force you to sell your futures, or more generally, close your positions. And if the exchange does so, this will also usually imply that you are banned from trading. If you are unable to pay a margin call, you will lose not only your money, but you will also lose your registration with the exchange. Has any one of you ever seen the movie Trading Places with Eddie Murphy and Dan Aykroyd? It's a classic movie from the 80s. Probably don't even remember Eddie Murphy. That's a shame. Okay, it's a movie, famous classic comedy in which two stock exchange traders, they make a bet that they can or cannot take a homeless person and turn him into a millionaire, and take a millionaire and turn him into a homeless person in just a couple of weeks. And in the end, they are fooled by Eddie Murphy and Dan Aykroyd, and they make the wrong bet on a futures contract. They think they know how the price for orange juice will develop, and they go short. They think the price will go down, and they try to corner the market, they short orange juice, and they they sell orange juice futures. Unfortunately, they have the wrong information. Then a press conference is made, and suddenly they realize that they have a huge open position and a huge exposure to orange juice. They try to sell off and to buy those contracts, they fail. And then in one of the last scenes of the movie, the officials of the futures exchange come. Suddenly the bell rings, and they say, "Oh, gentlemen, margin call. You need to pay 180 million dollars." And one of the characters says, "You don't know, we don't have $100 million. And they say, "Well, that's no problem. Close the accounts of blah, 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 sell off all assets, put their place on the exchange to the market and ask for bids, and they're bankrupt." By the way, in one of the later Eddie Murphy movies, those two characters reappear in a cameo. Then they are homeless. Yeah? So this happens. You need to pay up at margin call, and if you fail to do so, you will no longer be allowed on the exchange, usually. This is a margin call. And this process of changing the value in your margin account on a daily basis is called marking to market. You're marking your position to market prices every day. So you have the daily marking to market or the daily mark to market. This is what is meant here. Then your profit is what? Your profit, GT, it still stands for the German Gewinn, German profit. It's the difference between the current spot price and the future price you bought at. You bought at FS, and the difference is quite simply the difference between the spot price and the future price you bought at. For example, I would say I'm now buying a future on steel for 100. If at maturity the steel price is 150, I will make 50 euros in profit. Or I will lose money if it changes the other way. Now, during regular times, you will earn interest rates on your margin account. So you usually have the following situation. We assume that you have a constant debit and credit interest rate of I on each trading day. The balance is now this difference between FS plus 1 minus FS. It bears interest at I% for this period. For all days, and each and every day, you will get interest payments. And this last payment obviously does not bear interest because it's paid out directly. Okay, so for a long position, short position, it's just the opposite. You have the profit is given by the sum of all those differences between the future prices from day to day plus interest. And this is there are some differences between a forward and a future. A future can be settled on every day. You simply go to the exchange and you buy or sell the opposite number of future contracts. You can settle it every day. You can close your position. And of course, those payments on your margin account, they bear interest. So you have a slight difference due to interest rates. And when a long future is settled in T, the profit loss is simply not just the spot price minus FS, but the current future price minus FS. So the exchange can sell the position on any day. But again, the profit or loss function here looks the same as in the forward contract. €1 in profit due to a change in the future price, and €1 loss here for the opposite party. Okay. Now, if you take interest rates into consideration, the following profit loss results for the long position. Again, this is not just the sum of all future payments plus interest until maturity, but it's until settlement date T. You see, this is the difference here. Here we wait until capital T. Here we are settling in T. So this is the difference here. Now, how do you value these contracts? Because if I tell you I want to buy oil for delivery in 2 years, you would tell me, well, that's nice, but how should you fix this price for oil delivery in 2 years? It will depend somehow on the current price and the future price evolution. And it's quite interesting to see how this turns out. Well, making some assumptions, for example, the underlying does not yield any interest or dividend payments, so it should not be a stock. Again, we'll use KT as the spot rate of the underlying. FT is the fair price, the arbitrage-free price of a future. We assume that markets are arbitrage-free. And because it's quite difficult to have those interests in every term of the sum, we simply sum it up in RT, capital T, the accumulated interest for one monetary unit of invested or raised capital. So we'll simply put it in this additional term here, RT. So it's the accumulated interest rates. Now we compare two different investment strategies and we try to figure out what the fair price of future should be. We purchase the underlying using a future in S with settlement in capital T. So as a profit or loss, we'll have the spot price minus the future at which we bought. Second strategy, we are buying the underlying directly via a credit in S with settlement in capital T, and we have a loan of KS to finance this purchase of the underlying. And we're using the capital until capital T, we're selling the underlying and we are repaying the credit in capital T. So as a profit or loss, we get spot price minus KS, the spot price at the purchase of the underlying, times 1 plus the accumulated interest. And we can see that both investments are identical at maturity. And if they are identical at maturity and thus have identical cash flows, in an arbitrage-free market, they should have the same price. So what do? We simply compare the two prices. And we can see what happens now. The following must apply: KT minus FS equals KT minus KS times 1 plus the accumulated interest. Rearrange it a little and you will get what we call the cost of carry price, meaning the current future price should equal the current spot price times 1 plus the accumulated interest. And this is a very simple valuation. If you want to know what the oil price or the price of an oil future with maturity 2 years should look like, you simply take today's spot price times 1 plus interest rate, and you should get our best arbitrage-free price for the future today. This is the cost of carry price. And if we transform it a little bit, Ft minus KT, you can see that KT times the interest rate, the accumulated interest rate here, or the basis should equal what we call the cost of carry. And you can of course use different, more refined versions of an interest rate. This is a very simplistic view, but it suffices for our purpose. You could use a discrete interest rate, you can use stochastic interest rate, you can use a continuous interest rate here. For example, again, the future price should equal KT times the exponential function of R times the remaining maturity on the contract. If the interest rate during the year is approximated with a straight line basis, the following applies: KT times 1 plus R times the remaining maturity of the contract. But these are all variations of the idea that the future price should equal spot price plus 1 plus R. Yeah, should be the appreciated value of the spot price. Now let's assume a cost of carry price of KT times 1 plus R taken to the capital T minus T power. Now let's examine the variance or standard deviation of the futures price. We want to see how risky this investment is. And the standard deviation of the futures price is given by the standard deviation of the cost of carry price. And if you look at this is simply given by the standard deviation, the volatility of the spot price, times 1 plus R taken to the capital T minus T power. Therefore, the limiting case of the volatility of the futures price with maturity closing in on 0, so with the maturity remaining on the contract being smaller and smaller, is just the volatility of the spot price, which shows you that in the end the futures price will show a volatility that is equal to the volatility of the spot price. No big surprise, because in the end the futures price will converge to the spot price. Next, we are interested in the correlation between spot and futures price. And this is not a very big surprise. Simply have a look at those plots in which we plotted the spot price against the futures price. It's a linear function. And if it's a perfect linear function, then no big surprise here, the correlation is +1. But this also means that what? If you are long in the underlying, you simply go short in the future with the same underlying, and you will get a full hedge. +1 underlying, -1 future. 0 plus minus 0. -1 underlying, +1 future. Again, perfectly hedged. This is why these contracts are used for hedging. You have a perfect positive correlation, and then by going short in the future, you can hedge a long position in the underlying. Last result shows that, at least theoretically, you are able to complete what we call a perfect hedge or a full hedge. In reality, this result does not need to apply. Hence, the correlation is regularly slightly less than 1. This is what we call basis risk. If spot and futures prices are not perfectly, positively, linearly correlated, this is what we call a basis risk. And the theoretical basis is called carry basis. And the empirical basis is called the value basis. Right now there are a lot of papers out that study carry and that also study basis risk. Basis risk has some properties that make it ideal for studying certain things in risk management because it's very special. You might observe exogenous changes in basis risk, and you can use this for empirically studying the effect of risk management on risk and some other things. It's quite infrequent, exogenous changes to risk. But this is what we call basis risk. And here you can see that in the end, theoretical and empirical future price should not be and are usually not equal, but in the end, of course, they will all converge to the spot price. And the difference here, this is basis risk. And of course, this here, this is the basis. And again, at maturity, the basis will be 0, but before that, you might have a positive or negative basis risk. At the end of our analysis, now we consider an underlying that pays out a guaranteed payment Z in form, for example, of a dividend. Now, I don't want to go too much into detail here. You can imagine what happens now. You simply have to include this dividend payment in your cost of carry price. And this is what happens down below here. If you get a dividend in between, if you buy a stock in the future and there are some dividend payments, this should of course decrease the future price. And this is what happens afterwards. You can see that here the cost of carry price is not just given by the appreciated spot price, but it's minus the dividend payments. Okay. Now let's make a small switch because it makes sense here. You can see that actually this is the last part of the lecture, but we'll go back to financial derivatives in just a second. We'll deal with hedging with futures now, and later on come back to hedging with options. Very simple. We'll do a 1-1 future hedge. What is this? We want to cover and hedge an existing spot position, a long position. And we will do what is called a 1-1 short hedge. First, we neglect the interest on incoming and outgoing payments in the margin account, and the profit loss position of a 1-1 short hedge is just given by the difference in the spot prices minus the difference in the futures prices. Why? We bought the long position and we are selling it at maturity. And we are using a short hedge. So we are what are we doing? We are going short, so minus and minus results in a plus. So we are now getting the future price or the forward price, and we have to pay out the future price at the end of the maturity or at T. And if you now take this and compare it and rearrange it a little bit, you can see that actually Fs minus Ks minus Ft minus Kt, it's the difference between the basis right now and at the time we want to close the position. We want to settle the position. Now, what does this mean? It means that with a 1-1 short hedge, we cannot fully hedge right now. We can only see that we will get the difference in the basis as a profit or a loss. But you know that if you keep the future until maturity. If you do not settle it before, you know that actually this here, this will become zero. So the profit or loss of this 1-1 short hedge is the current basis. If you can now observe a difference in the futures to the spot price, this is the cost, the profit or loss on this 1-1 short hedge. So at this time, the prices will completely offset each other, and you will get a full hedge. So this is what happens. In case the basis is positive, you will be here. In other cases, you might be here. Okay. So you have a perfect short hedge using the future. Perfect in the sense that there is no longer any volatility in the profit or loss you are getting. Might be that you are losing money, but right now you know how much money you will be losing. And this will be deterministic, will no longer be stochastic. So this is the difference. Now, this assumes that you have the right future for this underlying. If you do not have a matching future, you will get what we call a cross-hedge risk. Simple example, you have a long position in BMW stocks and you are buying futures on the stock of Daimler. Close enough, but you will still see there are differences between the futures and the stocks of BMW and Daimler, and this will cause what we call a cross-hedge risk. You have a question?
Yeah, on the diagram we showed before, why isn't the hedging position at the crossing point of the long and the future short?
No, it just depends. It just depends on the current difference between the future price and the stock price. No, the future price and the spot, not stock, spot price. It depends on the basis. You have to be careful. Those are all prices at maturity. And actually, this difference here, you have to take this one and convert it to up here or down below. So the basis today is the level of the profit or loss you will get. And then you will see no volatility dependent on the spot price at maturity. So you have to be careful with the timing is. Okay. Now this is a cross-hedging risk. Unlike a short hedge, you can also do a long hedge. It's used not to hedge a yet existing, but a planned spot position. So for example, you want to buy a stock in the future. And for this purpose, you do a long hedge. So the profit loss position of a 1-1 long hedge is minus KT minus KS plus FT minus FS. And again, it's the difference of two bases. Just this time, the bases are quite opposite. Yeah, switched. So before maturity, the hedge may not succeed completely. At maturity, however, you have GT equal to minus BS. So minus the difference today. And here you can see that with the 1-1 long hedge, you can achieve the opposite profit and loss position of the 1-1 short hedge. From these pictures, of course, you can also see that if you can observe a basis, and if you are able to do such a short hedge or long hedge with relatively little transaction costs, you can immediately try to earn this risk-free profit. And this is why these markets are actually quite liquid. There are a lot of market makers in the market that will see this, and they will try to make a profit and to do the arbitrage here. So otherwise, this would be too good to be true. Now, let's analyze a short hedge. The observed portfolio consists of n shares of a spot price security with price Ks. In addition, you have X futures that each refer to one unit of the underlying, and we can then restate the profit loss position of the overall portfolio by profit is given by n times the underlying plus X times the future. I've highlighted this in blue and red here. Make sure you see the difference, that actually here it's KTS plus XST, and it's switched around. And then you can write it in this way. So if the future spot and futures prices KT and FT are stochastic, you can calculate the expected value and the variance or standard deviation. Now, the expected value, the mean of the profit and loss, is given by n times expected value of the spot price minus current spot price, not spot price, minus the number of futures times the expected futures price minus the current future price. And the same for the variance, just a little bit more complex with n squared and x squared and 2nx covariance. Now this is quite interesting to see. We want to determine the number of futures we need to find the minimum variance hedge. How many futures should we buy to hedge, to fully hedge a number of n underlyings? Now, it's quite simple. Take the equation for the variance, solve for the first derivative, set it equal to 0, and then solve for x. First derivative is given by 2x variance of ft minus 2n covariance should be set to 0, and we see that x, the optimal number of futures, is given by n times the covariance between kt and ft divided by the variance of the futures price. In other words, n times what we call the beta factor of the security in this future. Now, observe. You should not simply go for n equal to x. So it's not optimal, at least in a risk minimizing sense, it's not optimal to simply take, okay, 5 underlyings, 5 futures. This will not work here. Because obviously n is not equal to x. But you need a beta factor. Actually, the kf here in the beta factor, it stands for Korrekturfaktor from German, so a correcting factor, a correcting parameter. Now, can we reduce the risk to 0 completely? No. We still have a remaining risk that amounts to n squared times the variance of kt times 1 minus rho squared, the correlation between the spot and the futures price. Now, in practice, we can see that obviously the correlation between the spot and the futures price will be close to 1 and it will almost always be larger than 0. So we know that actually we can form the following equation, inequation: n times sigma, the variance or standard deviation of the spot price, times 1 minus the correlation between spot and futures price, is less than n times the volatility of the spot price. What does this mean? N times the volatility of the spot price is more or less the risk of n underlyings. And on the left hand side you can see actually it's the volatility of the hedged position is always smaller than the volatility of the initial n underlyings. So including a number of futures in the portfolio will always reduce risk. Can we reduce it to 0? Well, obviously, in which case, if you look at the second equation here, sigma of gt, it will become 0 in case correlation is 1. So if you have perfect correlation between the spot and the futures price, you will get a full hedge. then risk volatility is 0. This is what we call a hedge ratio. The optimal number, or the optimal ratio of number of futures or derivatives needed to hedge a certain number of underlyings, x star over n. In this case, this beta factor, the covariance between the spot and futures price and the volatility or the variance of the futures price, this is what we call a hedge ratio. Now, alternatively, you can also write it with a correlation. You don't need the covariance necessarily. Now, we could calculate the expected value of the overall hedged position by using this hedge ratio. You simply take the equation for the mean profit or loss, include the equation, the definition of the beta factor, and you can see that for t equal to capital T, we get the expected profit or loss is just n times the basis. This is quite simple due to the fact that before we saw the profit or loss is given by the basis. Today, if we buy n underlyings and hedge them, we will get n times the basis. For any t and the beta factor equal to 1, however, the following applies. We can see that actually the profit is given by n times the difference in the basis minus the difference in the expected future price and the expected spot price. So a positive basis that does not widen, that is not enlarged, results in a profit, whereas a negative basis that does not widen results in a loss. So depending on the current basis, you can earn a profit or loss, and if you observe a basis today and it increases or decreases, you might also earn a profit or a loss. Okay. This is a very simple analysis of very simple hedging strategies. Underlying, take a future, sell a future, and compare the basis. And if you don't have a cross hedge risk, so if you have the right futures, you can do a very simple hedge. And one has to be clear. In many industry sectors, like for example in energy trading, you will only see swaps and futures or forward contracts. You will not see exotic options. You will just see future and forward contracts and swap contracts because they suffice for the hedging purposes they need, the purposes they have. This is a forward, a future. Now let's turn to swap contracts, and we'll exemplify swap contracts by looking at interest rate swaps. Why? Because those are the ones that are very popular in the markets. What is an interest rate swap? An interest rate swap includes the exchange of, in general, fixed and variable interest payments on a nominal value, the principal amount, between two contracting partners. The underlying legal transactions and the resulting claims on repayment are not exchanged. And it's a binding, it's an unconditional derivative. So a very simple example, I have a loan. I'm a bank, I've given out a loan. I'm earning 5% interest on my loan. I am not interested in 5%, I want a variable interest rate. You, for example, for some reason, you have a variable interest rate payment coming in from a contract that is based, for example, on the LIBOR, the London Interbank Offered Rate. That is currently 4%, but it might also go to 6% or go down to 3%. And we agree that I want a variable interest rate payment, and I want to pay my 5% fixed, and you, the opposite way, you want 5% fixed, and you're willing to give up your variable interest rate payments. Then we agree on a swap contract, and for 1 year on a notional amount of, say, 1 million euros, I'm paying 5% fixed, and you are paying a variable interest rate, for example, the 3-month LIBOR or the EURIBOR. And this is an interest rate swap. This is a very simple example of a fixed floating rate interest rate swap. So in this fixed floating interest rate swap, fixed interest rates are changed with or transformed into variable interest rates. We again have a basis rate or an interest rate swap. That is, the variable interest rates are changed with variable interest rates. Simply means I'm giving you the LIBOR, you're giving me the EURIBOR. So we're exchanging two variable interest rates and not just fixed floating, but floating. Okay. These are what we refer to plain vanilla interest rate swaps. Plain vanilla because these are the most basic ones. You can distinguish many different types of swaps. For example, an amortizing swap, a forward swap, a swaption, an extendable swap, a callable swap, a puttable swap. Meaning that you have additional contractual features in your swap contract and you might not have a swap, but you have the right to enter a swap contract, but not the obligation, then it's a swaption. You can extend it, you can call it, you can put it, and so on, and those are just variants of a plain vanilla interest rate swap. Now, it's not so simple to say I'm the buyer or the seller of the interest rate swap. Because imagine I'm giving you 5%, you're giving me a variable interest rate. We are both selling and buying at the same time. So who's the payer, who's the receiver in this contract? Has been common notation and common ground that here, in a fixed floating interest rate swap, the so-called fixed rate payer pays fixed income. So every time you pay fixed income, fixed interest rates, you are the payer. You are the buyer of the fixed interest rate swap. And if you are getting the floating rate, then you are the seller or the receiver. Again, you see it's a derivative. You need someone who goes long and you need someone who goes short. If you buy it, you're long. If you sell it, you are short. And they may be interested in the way these things are constructed, but this is a basic way of doing the swap. Do you all understand what is meant by the phrase that a derivative market, especially a swap market, is in zero net supply? What does it mean that this market is always in zero net supply? You might remember this. I think I've told this last time with options.
Whenever there's a buyer, there must be a payer. It can't be a single side left.
Buyer and payer? No. Buyer and seller.
Yeah.
Yes. It's not like in the stock or a bond market. In the stock market, I, for example, could say, I'm giving out stocks. I will throw the stocks into the air, and if you, as market traders, market participants, are not buying the stocks, they will just lie around, and I can produce more stocks by raising capital, and suddenly the net supply is positive. Someone owns, and you could all have a long position, and the difference, the netted position of all long and all short positions will be positive. So stock and bond markets are in positive net supply. It's totally different for derivatives market, and this becomes quite clear in the swap contract. I cannot do a swap contract without someone else agreeing on the opposite position. If I go long, I need someone to be short in this contract. If I don't find someone who does this, I cannot enter a swap contract. And this again shows you financial derivatives are markets in zero net supply. They are a zero-sum game, and whenever you have a long position, you need someone else to have a short position in the right amount. Okay. I'm neglecting this a little bit. Now on the following page you can see some constructions how you can do this. You can do it with an asset swap, an asset liability swap, a liability swap. It simply says that from which assets or liabilities are those payments coming from? I gave you the example of me as a bank that has given out a loan. So I'm getting 5% interest rate on an asset. And if, for example, you've given out a loan and you are earning a variable interest rate, it's an asset swap. Because we are swapping two interest rates that originated from two assets. Now, if, for example, I have to pay 5% fixed on a liability, on a loan, and you have to pay a variable payment, a variable interest rate on another loan, we can again switch those two interest rates, but then it would be a liability swap. It would not be an asset swap. Is that clear? So these different variants of an interest rate swap, they only differ by the origins of those interest payments. They might be from an asset, asset, liability. This is just what is shown here. There's a main structure, an asset swap, liability swap, an asset liability swap, and you get all those variants. How can you value, how can you price such a swap? Quite simple. I give you 5%, you give me a variable interest rate, but no notionals, meaning that the fixed rate payer actually goes long in a money market investment and he or she goes short in a fixed interest payment, the other way around for the floating rate payer, and in the end you will get as a difference the price party A has to pay party B or the other way around. Let's look at this. Now I have this is what I want to pay, and this is what I want to get, a variable payment, 4 periods. What could I do? Now, I am the fixed rate payer. So what do? I will go short in a fixed interest payment, which is nothing else than a coupon bond, and I will have a money market investment, which is usually a floating rate note, and you can see that if you edit those 100 notional, they will cancel each other out, and you are left with minus 55555 plus the variable interest rate in each quarter, in each period. And again, this here is the position for the fixed rate payer. You can simply price each leg. This is what we call them, the payer leg and the receiver leg, or the fixed rate payer leg or the floating rate payer leg of those two contract sides. And then you can see how much worth is one side compared to the other side. And do you know what you would do in practice? If you find out, for example, let's make a very simple example. I want 10% fixed. Now with the current interest rates, this would mean you have to pay you would pay a variable interest rate that is close to 0, and you're getting 10%. Now obviously, I'm getting a lot of money for a very low variable interest rate. Meaning, I will probably have, if I'm paying you 10%, you would have to pay me a fixed amount right now. So the swap contract is a certain price, and in this scenario, you would have to pay me to enter this contract. But what else could I do? What is done in practice usually? In practice, you do not fix the 10% simply at 10%. You will say the price of the swap contract should be 0 today, so there should be no payment into one or the other direction. And then, of course, you have to adjust this here. And this 5% fixed rate we would probably fix it at 0.1%, 0.2% in order to make the payment to be equal to 0. And this is what is called the swap rate. Swap, Satz in German. This is swap rate. Okay. Swap contracts are, of course, a little bit more complex. You also need some day count conventions. You need to look at the question, when are interest rates due and when are payments due? How are interest rates calculated? You need to come up with a so-called day count convention that tells you how many months and how many days in a month do you have. There are some market conventions, for example, actual 360, 30, 360, 30, 365, and so on. And you simply assume, for example, each and every year has 360 days or 365 days. This makes it sometimes easier to calculate the interest rate payments. Yeah? And those are some market conventions on swap contracts. The pricing of interest rate swaps means that pricing is done including all charges and on the fixed reference interest rate. You have a so-called markup or the so-called spread that is added to this swap rate, and this is the result. In German it's the Swapsatz, and it's called the swap rate. And many cases market makers and large funds and banks will publish swap rates, and they can be seen on the market. Swap rates on interest rates and other things. You will also observe bid and ask rates, meaning that you will have two different prices to enter a swap contract as a fixed rate payer or a fixed rate receiver, depending on the market. And a financial institution will enter a swap transaction as a fixed floating rate payer at the bid rate. And again, the difference between this bid and ask swap rate will tell you what? As always, as with any financial market, the bid-ask spread gives you a proxy for market liquidity. If you have a large bid-ask spread in swap rates, there is not much liquidity. And if the bid-ask spread is quite small, you will see that actually you have some market liquidity. How could a plain vanilla interest rate swap look like? For example, a fixed variable interest rate swap on the 6-month Euribor, maybe not Libor. The nominal value of the swap is not subject to changes during the term of the swap. So let's say a 1 million euro 6-month plain vanilla interest rate swap. And the agreed fixed interest payments correspond to the market level in the form of a market interest rate for the maturity of the swap. As a result, there are no settlement payments at the beginning and at the end of the swap contract. Why? Why do you just use the swap rate that is marked to market instead of having a large payment in the beginning and at the end? Why? Think like a risk manager.
The other party could go bankrupt and you could lose.
Yeah, but even more important, for what purpose are you using these derivatives? Hopefully just for hedging. And hedging is not about capital expenditure. It's not about using huge amount of capital that could be put to other use in your balance sheet. It's about getting a certain effect out of your hedging instrument. And it doesn't matter if you have a large payment in the end or in the beginning. If you change the swap rates, the effect for hedging purposes will be exactly the same. And so why should you use so much capital in the beginning if you're only interested in the hedging effect of this instrument? So both parties will agree on a small or even zero payment in the beginning and then they will just look for the effect that takes place due to changes in the interest rates. Very similar construction is a credit default swap. In a credit default swap, I will ask, as a bank, I will ask someone of you, imagine you are an institutional investor, I will ask someone of you to enter a swap contract to swap credit risk. How shall we do it? A credit default swap works like this. For example, I'm an investment bank, I'm now Goldman Sachs. You are a fund or you are a company that needs credit insurance and default insurance against the default of your fellow student who is now BMW. You have some exposure against BMW and you want to swap credit risk. So what do? You come to me, I'm an investment bank, and you ask me to offer you a credit default swap. And I will offer you a 5-year, that's very frequent and very common, a 5-year credit default swap with BMW as the reference unit. Notional, say 10 million euros, 5-year contract, and you have to pay, because BMW is very safe, it's very risk-free, you have to pay 1.5% on the 10 million, let's say 10 million on the CDS. That is a CDS. It's OTC, it's not traded on the exchange. We can agree to any terms in our contract we want to, and I don't care if you have given out a loan to BMW. If you have any link to BMW, if you tell me you want to buy this, I price it, and if I say 1.5% is my price and you accept it, we two agree on a credit default swap that works like this. You're paying me 1.5% for 5 years, and in case a trigger event happens, like for example bankruptcy filing of BMW, I will pay you 10 million euros as credit insurance. If nothing happens, I'm just earning 1.5% every year, and in the end you get nothing, but BMW has stayed solvent. That's a credit default swap. Same year. Also, bid and ask price. I might offer you 1.5% and 1.8% as bid and ask spread respectively. And this 1.5% is what is called the CDS spread. It's the additional spread you would put on the risk-free rate to get the interest rate payment for giving a loan to, for example, a BMW. It's risk-free rate plus credit spread, and this is the CDS spread. Because we are not switching, we are not exchanging capital, we are simply swapping credit risk. And there's one difference to a bond. Is this clear? If not, watch the movie The Big Short. This is exactly the same Christian Bale does. He goes to Morgan Stanley or JP Morgan and he asks them for credit default swaps for a couple of $100 million against some funds, some portfolios, credit, loan portfolios, mortgage loans. He simply has brochures and says, I need CDS for this, and this portfolio. And JP Morgan says, yeah, we can do it. And they price it. And of course, if those reference units default, the seller of the CDS has to pay up. And this is my risk. But you've given credit risk, you've transferred credit risk from yourself to me. This is why it's called a credit default swap. Okay. Yeah?
Isn't that pure speculation?
No. It's actually very simple credit insurance and default insurance. This is what, for example, this is done on a daily basis by insurance companies. But usually in these cases, you are selling, for example, a machine, you are selling goods, and you're putting it on a freighter, and the freight ship will go to, say, Mexico, and you will have freight insurance, and you will have loss insurance against the loss that the buyer accepts your goods but cannot pay because he now is insolvent, and you will not be able to get your machines back from Mexico. This is done on a daily basis by insurance companies. The difference now is with the CDS, we can agree on a CDS without you having any exposure to BMW. Same example, imagine the insurance company wouldn't care about you sending goods to Mexico. Nowadays you would go to an insurance company and say, I'm exporting goods to Mexico. And the insurance company will check it and say, yes, we're insuring your freight with, say, 5 million. But this makes it much less liquid, and of course, it makes it more manageable and easier to price for the insurance company. But if you simply want to hedge against this risk, you could also try to buy a credit default swap. And this is what can be done. There are some variants also. You can include this type of insurance in a bond. And this has been done quite famously, and then you get what is called cat bonds, catastrophe bonds. Insurance and reinsurance companies issue those bonds, and they just say, we are paying interest on the bond, we need 5 billion euros, we need cash, we need capital, we are issuing a bond, but with one caveat. If a trigger event is triggered, we are not repaying the bond. So we have additional, more or less a credit default swap included in the bond. And they are quite common in insurance and reinsurance, and they're called cat bonds. And what you do is, you usually, as an insurance company, you will have a trigger event, for example, a large natural disaster in Louisiana, a large fire outbreak in a city. And they can be quite exotic. You know, one of the most famous examples of cat bonds issued by FIFA, the soccer association, against any type of disaster that would have prevented the 2010 World Cup. And you might check this on the internet if FIFA has again issued a cat bond, meaning that they don't have to repay the loan, the bond, in case the World Cup does not take place. There's a famous example of a cat bond, the FIFA issued one. And it includes a credit default swap, more or less. Okay. Now, the valuation, we've seen this. You simply price the two legs, and the difference of the two legs will be the price of the swap, and one has to enter price. Now, you see that actually the long payer swap can be understood as a portfolio of a short coupon bond with a fixed interest rate as a coupon, and this corresponds to a floating rate note versus a bond, and the value of the long payer swap is the price of a floating rate note minus the price of a corresponding bond. If you set it to 0, you need to adjust the swap rate. If you have a fixed swap rate, like the 10% in my example before, you will get a positive or negative price here for the long payer swap. And that's the valuation. Okay. Now, one can consider various motives for the use of interest rate swaps. Usually, you have an interest-bearing position. You are getting a fixed or you're getting a variable interest rate payment, and for some reason you want to hedge against this. You want to swap it. And you can use it for active interest rate management. You can also, if you are expecting interest rates to go up, you can try to speculate. Now, this sounds like a gamble. It is, obviously, but I would be pretty sure that we will see increasing interest rates in the future. I mean, we are currently at 0 or minus 0.2%. Interest rates can only go up. So I would assume that it's safe to say interest rates will increase in the future. Of course, there's some insecurity regarding the questions when and how. But you can try to go short here and to enter a certain swap contract, and you can try to bet and speculate on increases in interest rates. And this is done in active interest rates. Okay. Do you have any questions? Because I think I've taken up enough of your time by now. We'll have a look at those different strategies, how to use interest rate swaps next week. So do you have any questions concerning futures, forwards, swaps, credit default swaps? Okay. If not, we'll continue here next week, and thank you for your attention, and well, see you next week. Yep, thanks.